Do you ever look at your business and wonder what is it actually worth, but you're not sure how enterprises get valued? Some companies at a $5 million revenue level can sell at 2x EBITDA, and some can sell at 5x EBITDA. Now, after selling Bellator Group Australia and my shares within that, as well as buying and selling other companies within that period of time, I wouldn't say I have the number one best idea of how to sell companies, but I have a pretty good idea on what they're actually valued at, and then how you actually get there at the different revenue levels. So today we're going to cover the exact valuation framework that businesses use to actually value financial services companies, and how to get a 2x EBITDA, 3x EBITDA, 5x EBITDA, so you actually know where you want to be, and how different levels of revenue and EBITDA actually directly affect the multiple that your business is actually going to be able to sell for. So let's jump right in. So the math behind financial services valuations. So most financial services people and brokers think doubling EBITDA from say 500,000 to $1 million doubles their valuation. They're actually completely wrong. So as your EBITDA grows, you don't just make more profit, but you're making a much more sellable business because you have more resources, more talent, and more everything like that. So we're going to give a very, very big example here. So $3 million in revenue in 750 in EBITDA could sell at say a 3.75x multiple. So a $2.5–3 million exit. However, the same $3 million business but has a $2.2 million could sell at a 6.5. Now the reason why is because one, profit and percentage of profit is one of the main factors that businesses actually look at when actually acquiring other businesses. Because if your profit is say at 5%, your risk is such a larger risk than say if your business is running at 30% margin. Now, same revenue, same year, same market conditions, etc., but growing from say a $500,000 EBITDA level to say a $300,000 EBITDA level, and to give that into perspective, you're either doing $40K per month net profit, or you're doing approximately $250K per month net profit. You can literally get about a 15 to 22x on your return. And the reason why is because a $500,000 business, which we'll cover in a second, is not going to be anywhere near as valuable in terms of the multiple of a $3 million per year EBITDA business, because this could be say a $2 million or a $1 million company, and it has one or two main staff. And then a $3 million EBITDA usually is a 10 million or more, an 8-figure or above company. And that would have most likely 3-4 real A players, maybe one superstar, the founder's really good, plus a team of probably 10 or more, as in the other people as well. So we'll know, and we'll go into the actual thresholds, why $2 million EBITDA can be worth 4x more than a 1.51, the 6 value drivers that actually determine why you get a 3x or a 9x, and then which levers to pull right now as well to make sure you know the next steps and what you're actually going to be focusing on. So we obviously just covered this. So basically, T1, what I would call, is sub 300,000 EBITDA. Now, this could be an individual broker buying books. This could be locals acquiring different competitors within their state or nationwide, for example. And let's say an insurance broker is selling an $800,000 book to a neighboring agency or something like that. This kind of sale will usually attract 1.5, 2.5x the actual EBIT, because they're not going to be a huge amount of value in this size of companies as well. So, because what most buyers actually going to care about is the clean list, but you're not going to have then a huge amount of clients when you're doing, sub $300,000 a year. The transferable relationships, which again are going to be very difficult to do, and then compliance history. You're not going to have compliance officers or anything like that. Okay, so the biggest bottleneck here is you usually are the business, which means it's not very valuable at all. People are going to be willing to pay 1, 2x of what that is, and then also your pool of buyers is going to be way smaller. Now, this is where you start really talking tier 2, which is 300K to 750K. So an example, could be another, insurance agency with $2.5 million in premiums and a 70% renewal rate. So an amazing book. Or it could be a commercial finance business doing, 15 million in deal volume annually. Something that is, again, a single person. So it's mainly going to be a founder at this level because they're doing, say, 50, 60, 70,000 per month, which usually in, say, commercial finance is someone who is doing in volume, a couple million in volume. And then or a mortgage broker processing, 150, 200 loans per year with, a few loan officers, a few mortgage brokers, etc. So what buyers really care about at this stage is the actual retention, so that they know at this multiple, is this book and is these kind of companies going to actually continue to print revenue? Okay. Now, Team stability, huge one. Other actual proper SOPs and things of that nature within that, as well as technology infrastructure. So CRMs, data, all of these, because you're starting to really spend some money here. So let's say it's 500,000 and it's at a 3x. So you're straight away putting in 1.5 million. That's not a small amount of money. So, but the biggest bottleneck, once again, is you're still going to be the rainmaker in finance. Okay, the growth actually depends on you. You don't have a proper C-level executive, a COO or a CMO or something like that that can really control and grow that area of the business. Next is going to be tier 3. This is when lower mid-market PEs start watching. An example of this could be an employee benefits brokerage with 200 plus employer clients. It could be a business finance brokerage with small business lending specialties. So for example, cash flow, and they're doing in the realm of say 3 to 5 million total top line revenue. But the biggest thing is going to be the actual senior producers. So it's going to be either top level advisors. You actually start to have some A plays in the team now as well. So you've got, again, a documented service and sales model. You've got marketing systems that are able to generate leads. All of your actual systems for creating data, so that you have all of your sales metrics, all of your marketing metrics are really, really dialed in, and you actually can bring people on repeatedly. So you've got amazing hiring systems in the front of the business, and you actually know that your management team can do things, but not at the level at which you're not required yet, not at tier 3. Now, next is going to be tier 4. This is where mid-market private equity comes in. Okay, so for example, this could be a multi-location insurance agency. This could be a mortgage shop doing 250 million plus in annual volume, 8 to 12 loan officers, dedicated processing team. This is really where 8 to 12 loan officers, for example, or mortgage. An example where you now would have a sales manager or director of sales. You can have those loan officers writing good volume. Based on this, they're running 2, 3, 5 million even per month, sorry, and then you're going to be moving from there. And just what I realized as well, 8 to 12, you're probably going to be doing a little bit more than 250 in annual volume, probably doing double that, because 2 to 3, 4 million for a mortgage broker is not actually that high. But dedicated processing is going to be one of the main points as well, that your actual back end team can really support any new mortgage broker that actually comes on. Okay, so again, this could also be a commercial insurance brokerage specializing in something very specific, but you're looking now at the revenue tiers where you're closing in on 8 figures, $10 million a year, because you really need to have a president or a COO that is running full day-to-day so that you're out of the company. You need to make sure that you have organic growth track record, and that's both in new employees that are going to be coming in, as well as you've got the actual organic side, meaning leads are starting to come in as well. You actually have a referral network that isn't just paid ads or one acquisition channel. Because at tier 4, at this kind of level, you need to really make sure you have multiple levels of acquisition, you have multiple proven levels of acquisition, minimum 2 or more, and you have all new client cost metrics as well as your existing client cost metrics, okay? And this is where technology and process modes actually becomes a big, big thing. You need to be able to look at your business and basically say, why is my business separate to the person down, Joe Blow down the store? Like, I potentially have a very good software that I'm able to use. I have amazing processes and systems. I have the best team you've ever seen. We're the fastest you can ever be. You need to have something like that you really, at this level, you need to have that. Otherwise, basically, you're not going to be able to get to this level anyway. So that's a big thing. So the unlock is you could literally step away for 3 months and the firm still grows. You're able to get people in, leads in, and deals closed. Now, this is really where your actually strategic buyers are active, okay? So again, national mortgage platform with light label technology. For example, you're some kind of aggregator. Again, financial services brokerage with the insurance planning and business finance division. So you now have multiple divisions. This was like Bellator Group Australia, what we had. And then a benefits brokerage servicing, 500 plus employer groups, for example. And this is really, really well. You have huge levels of scalable infrastructure. So SOPs are absolutely fully documented, fully constantly being improved month on month. You have internal cross-sell capabilities, so your leads are able to go in between different departments. And this could, if you have one type of business, meaning you don't have multiple divisions, this would be looking at how do you cross-sell and upsell different people. So for example, you're a mortgage brokerage. How do you actually take a mortgage brokerage and you basically refer asset deals, refer cash flow deals out, and you don't have to service them internally, but how do you get money back for those so you can actually have a proper lifetime value for your clients? And then you have brand recognition and niche. Now, what does this mean? This means your organic leads and referrals are through the roof. They're making up 20, 30, 40 more percentage of your revenue, so you're not so reliant on paid acquisition channels where you're having to put in one input and you get one input out, where it's a scalable level of actual input. And this is probably one of the biggest things that finance companies miss, is proper brand recognition. And then acquisition integration capability. What does this mean? Your team doesn't require you to be within the business, meaning they can come in. So recently I've actually been working on a deal, a very, very big deal. That's probably not going to go ahead, but basically I've been working on it for months with a partner, and we've been working on that for months. And the integration into this company was going to be super easy, but it didn't have any of the saleable kind of SOPs. And by the way, this company was above this. This was in a tier 6. They've been doing EBIT. So, well, it's actually, a fair bit over. This kind of company, it had easily, because there wasn't many people, the actual size of the business was actually huge compared to the level of actual staff that they needed. They had less than 10 staff and they're doing, more than 5 million EBIT per year. So imagine what kind of company that could be. Absolutely crazy. Very easy to actually go in and have infrastructure within there, but they didn't have any SOPs, no infrastructure, no proof of actually showing that they could bring on new clients at a set cost, no metrics for sales, no data. And then on the back end, they had no way, and just had no data. There was just nothing. So it's super unfortunate. But you've built either to make the differentiator, you've got a different platform, not just a practice. So you've got something that is so different about your business that you're able to keep scaling. You've got better ways of bringing on brokers, or you've got better ways of servicing clients. You've got something like that, okay, that they can integrate into their existing systems. And then finally, this is where, when you're looking at 5 million plus EBITDA, you're looking at a business that's doing, 20 million per year or more. And this is, for example, again, a mortgage platform, multi-state, consulting firm in financial services, something like that, or like a wealth management firm with 3 billion plus in funds under management, for example. And you are considered one of the market leaders in your acquisition channel, meaning paid ads, you're a market leader, organic, you're a market leader, or in all of them, you're considered a market leader. And then you have a proven track record as well as a buyer, meaning you have years of proving growth. You have years of proving increased and better efficiency in your systems. You have years of that as well as a full executive team. So you now have multiple levels of structure. Usually there's 3 levels. There's the C-level executives. You obviously go down to upper management, meaning team leaders, people like that. And then you go down to not front level, but media buyer, or for example, SDRs, brokers, etc. So that's basically it. And then you have the ability to have software capabilities, meaning you've got something internally that really is a competitive advantage in software to make things significantly easier with automation, AI, or something like that. Okay. And then basically the reality is you built an institution that someone could come in and buy either 50 or 51% or up to 100%. And they're the company that they buy and it just prints money, and they could literally feed in dollars on this end and it comes out as, 2x, 3x, 4x, 5x. And those are basically the different levels of the tiers within financial services, and what you can see different companies at different levels and what a buyer would be looking for, as well as what kind of actual buyers are in the market for that kind of company. Hopefully that was valuable, going through all the different levels and what it actually looks like, whether it's a low-end multiple for that different tier and it's actually a high-end multiple for that given tier. Now, this isn't the only way buyers look at it, but it's the way I actually structure the different tiers and the way you can look at and know, does this actually have A players? And if it doesn't, it's more towards the lower end of that range that you saw of, say, a 3.5x to 5x multiple for the different tiers, okay? Because if it doesn't have good infrastructure or good people, it means it can't be at the top end, so it has to be at the lower end. Now, look out for next week's video where I go into the actual 6 drivers of those things and what you actually can do today to actually get to the different tier levels and keep going up. So hopefully that was valuable. Like, comment, subscribe, and I'll speak to you guys soon.